Hi everyone, Caroline Bell with another weekly live Q&A. So we've received a couple of questions this week, so I'll run through the questions as per normal, but it would be great if anyone's here just to register with a comment and introduce yourself just with your name. It's great to actually sort of see some names, particularly some familiar ones, particularly given I'm just sort of talking into a screen, so it gets a little bit distracting. But we'll start off with the first question, and this one came in from Christine. So her question was, if we're heading towards a depression as the media is spruiking and preservation of capital is important, which is better, cash or shares? Now, I think many of you know my opinion of the media, particularly when it comes to financial reporting, in terms of they're very much focused on selling stories, and the emphasis there is on selling, and essentially stories. Really, there's so much hype and fear-mongering with the media. I'm really not a big fan of certain media channels at the moment. And let's also talk about the word depression. So if anyone watched the live Q&A last week, or the recording that's available in either the Facebook group or on the Summerhill YouTube channel, we talked about the difference between a recession and a depression. A recession being 6 months worth of the economy shrinking, and a depression being essentially minimum 12 months of the economy shrinking. And as we talked about last week, in 166 years, I think it was from memory, there's been 33 recessions and 1 depression. So I think it's a little bit irresponsible of media to be talking about depression. It is quite possible that we go through a recession, but the country's been through many recessions before, and it could be a V recession. And by a V recession, we mean it goes down very quickly, which is what we've sort of seen, just given the labour market has essentially stopped, but it goes up very quickly as well. But we won't know that until we're sort of going through it. But to answer the question, if we sort of do start going into, let's say, a recession, and preservation of capital is important, which is better, cash or shares. Now, essentially, this is where doing risk profiles and understanding your risk is really important, as well as what your goals are and your comfort level. So essentially, at this stage, if you're in the right portfolio, there should be no reason to be switching to cash if you're currently invested in shares. And to be honest, depending on what sort of stage you are, you're going to have a combination of cash and shares in the portfolio anyway. There's very few people that should be or are invested 100% in shares if they have a professionally managed investment portfolio. It's one of the mistakes that DIY investors or first-time investors make, is when they start investing, they put everything into shares, not realising that a professionally managed portfolio has a combination of different types of investments. So for anyone who has a Summerhill portfolio, whether that's Summerhill Financial or Summerhill Invest, and you see that the All Ords or the ASX 200 has dropped on the news, your portfolio hasn't dropped by that amount because you have a diversified portfolio with various investments in it. And in fact, we're finding with some of our clients that we've been speaking to, they've been surprised that their portfolio hasn't dropped as much as they thought it had because of what they see on the news, because they're not just invested in shares. And so it really comes back to, you should be in the right portfolio for you that should handle every type of situation, including these types of black swan events. And as you know, we talked about black swan events in our first live Q&A, these rare and unexpected events, but do happen from time to time. So preservation of capital is important, and that's why having a good mix of shares, bonds, cash, and even property is quite important. The next question that we've got is, have we seen the bottom of the market? And the answer is, we don't know. No one really knows when the bottom of the market is. And to be honest, you never know when the bottom of the market is until after you're out, because it's only with hindsight that you can look backwards and see that that was the bottom of the market. Was the 18th of March potentially the bottom of the market? Maybe. And the market was so oversold at that point in time because there was so much fear and panic in the market that it reached a certain point where more experienced investors just realised that even if the market stays volatile for quite a period of time, it was so cheap at that point in time that even if they hold on to it for a year or more, they were going to make good returns. And this is where discipline and a little bit of confidence in the market, as well as patience, really pays off. So maybe we've seen the bottom of the market, maybe we haven't. And because we don't know if that's the bottom of the market, this is where dollar cost averaging comes into play and can be really useful, particularly for first-time or inexperienced investors, where if you are thinking about getting into the market, rather than investing all of your savings at once, and of course you should be leaving money in a savings account anyway as your emergency cash buffer, but for the money that is available to invest, it is possible just to invest it over a period of time. So if it's not the bottom of the market, then maybe you'll get the benefit of any future falls. If we have seen the bottom of the market, then if nothing else, you've invested a portion relatively at low prices. And then if it continues to grow, then that's sort of only good news. But if you are investing for the first time or relatively experienced, you actually want the market to stay relatively low for longer. So this is going to be an interesting question in terms of whether we have seen the bottom of the market or not. But it's really about your comfort level in terms of whether you're ready to invest now or whether you want to wait longer. If you do wait longer, maybe the market continues to increase, although I do think we'll continue to see some volatility for a little while yet until this is the COVID-19 situation. Really, we're seeing some real light at the end of the tunnel. But certainly that dollar cost averaging approach is really a good way to go. Then this is a question that comes up quite often, particularly with new investors. Do I need to take a high level of risk to achieve a higher return? The short answer is yes. Essentially, the old sort of saying is there's no risk, no gain, no reward, no risk. That exactly that applies. In relation to this is where we have the different types of investments, and what we're seeing at the moment is the perfect example. And let's use the previous question in terms of cash versus shares, just to make it really simple. Absolutely, you can leave your money in cash and you have that sleep at night factor, knowing that the money that's in the bank account is going to be exactly the same amount tomorrow, and maybe you earn even a little bit of interest. To get a higher return, though, that's where you do have to take that high risk. And what we're sort of seeing now is the perfect example of where potentially taking this higher risk and investing in a volatile market can lead to higher returns if you're patient and you have the investment time frame. So a condition of this higher return is essentially patience, discipline, and time. So if you need the money in 6 months, then you shouldn't be taking a higher risk to achieve that higher return, because that higher risk isn't worth it if you know you need the money in 6 months. If you can leave the money and you're putting it away for your goals for at least 2 years, ideally 3 years, then you're in a position where you can sort of take that higher risk to achieve that higher return, because you've got time and to actually use that patience and discipline to get those market returns. And then just with the last question for today, if I take a high level of risk, so this was a sort of a two-part question, if I take a high level of risk with the aim of achieving a higher return, how can I best manage that risk? And this is an interesting one, as this is where diversification comes in. So by diversification, we talk about having different types of investments. And by different types of investments, we're talking about investments across the main 4 asset classes, being cash, bonds, shares, and property. And so you only get rewarded for risk that's worth taking. And a particular type of risk that's not worth taking is when you're investing in a single stock. If you invest in a single stock, let's pick on BHP, then you're very much dependent on getting the return of what BHP does, regardless of what the market does. And so that is a type of risk that's not worth achieving. And so to manage the risk, the best way of achieving that is investing in the whole market. So at least then you know you're getting a market return. You're not taking extra risk on one or just even a handful of stocks. And the best way of achieving that, of course, is with ETFs, exchange traded funds. And that's one of the reasons why we choose to have exchange traded funds with Summerhill Invest, to really sort of take away that risk and provide you with just getting the best return that you possibly can, with some risk, because without doubt, of course, investing in shares does have risk, as we've seen. They are volatile. Share prices go up and down, but you're only taking that risk that's worthwhile. You're not necessarily taking any risk that you're not going to be rewarded for. I've just noticed that I'm sort of not very good at looking at the comments. I sort of get carried away when I'm speaking, but I've seen that Chris has joined, who had the first question. Hopefully Chris was on board when we answered her first question. If not, Chris, of course, you know that the recording will be there as well. That was essentially all the questions that we had received for today. The one thing we'll sort of say is doing this every week, listening to me speak for 15 minutes every week can be a little bit tiring, I can imagine, and sort of getting tired of my voice. So we're going to be reverting to fortnightly. So the next live Q&A won't be next week, but it'll be the week after, and then fortnightly every 2 weeks. Any questions, please? Love to receive the questions to be able to answer them in this format, and hope to see you soon. Thanks very much. Bye-bye.